Good afternoon, everybody, and welcome to today's webinar hosted by the M&A Advisor. We are delighted you can join us here today. Please submit your questions throughout the presentation by using the question box on your screen. Our presenters will answer as many questions as possible during today's interactive virtual session. If you have any technical issues, you can contact us by using this chat box as well, or simply hit the help button on the bottom of your screen. Good afternoon, everybody. I'm Steve Fleming, partner and business recovery services leader at PwC. I've been spent the last 23 years of my career doing turnaround and restructuring advisory based out of our New York office. I am joined here by my esteemed panelist, Navin Nagrani, who's an executive vice president at Hilco, and Vin Batra, a managing director at Configure Partners. I'll turn it over to each of you gentlemen to introduce yourselves and give a little bit of your background to the audience.
Sure. Well, how about I start? Let me first thank you for the invitation to be on your panel for the M&A Advisor. Certainly as a conference group, it's somewhat challenging to host conferences, but everyone's tried to adapt, and certainly appreciate the brand and strength of the M&A Advisor in the marketplace. And so looking forward to this discussion today. I'm an operating partner at Hilco. I've been at Hilco for now going on 18 years. Most of my career has been spent in the restructuring arena, generally dealing with assets from a valuation perspective to an advisory or monetization perspective, to also as part of Hilco's general business, being an investor, both in debt as well as assets directly. In particular, I've spent most of my career at Hilco in the restaurant space. And just by way of context, today, given COVID, we've been heavily involved in the restaurant arena, serving as advisor on the real estate side for notable groups that filed, including California Pizza Kitchen, Chuck E. Cheese, Bravo Burrito, Craftworks, Ruby Tuesday, and a handful of smaller operators. So looking forward to just providing some insight and perspective for my window of the world.
Great.
Great. This is Vin Batra from Configure Partners. Echo Navin's comments about M&A Advisor. I think having these, in some ways, having these virtual conferences helps us get to a wider audience and also focus the content on just a particular industry or a particular product. I'm a managing director, as I said, with Configure Partners. We are an investment bank. Our products include M&A, special situations, and financings. Most of my career, which has been over 25 years, I've been a special situation banker. And at Configure, I also lead the restaurants vertical. Prior to Configure, I worked at firms like Lehman Brothers, Alvarez and Marsal, and a few other middle market investment banks. Interestingly, we worked on probably 8 M&A and special situation transactions in the restaurant world in the last 18 months. Post-COVID, we completed 4 M&A restaurant transactions and currently have 2 ongoing restaurant transactions. Interestingly, as we sit and look at this, when you see publicly, restaurants were already suffering earlier, and we were in bankruptcy on a few cases, namely Restaurants Unlimited, which was last year. In fact, we got the M&A Advisor Award on that. And then some new cases post-COVID. We did Bar Louie, Craftworks, and the environment has just changed substantially. And we're all looking forward to getting into it. The way where we sit, given our experience, we do understand the do's and don'ts of restaurants, whether it's for transactions or for management teams and the various stakeholders. And would love to answer questions after this presentation session. So let me, with that introduction, let me flip it back to Stephen.
Great, thank you both. I'm really looking forward to today's session. And I'll add that I too have done a lot of work over the years in retail and particularly the restaurant sector. In fact, I was involved in one of the post-COVID restaurant cases of Le Pain Quotidien, where I was the chief restructuring officer. Thankfully, that case had a great ending, and we were able to find a buyer there and save a great brand. And that's that's been a trend that I've been seeing, and I'd love to explore a little bit further in terms of what you guys are seeing in the market from a distressed investing standpoint and availability of capital, who the buyers are, and what your views are as this very challenging fall and winter approach. So with that, let me start off by asking Navin my first question here. In 2020 is already shaping up to be quite a year from a restructuring perspective for restaurants. I believe as of this morning, with an additional filing that we saw of Rubio's, we now have more restaurant Chapter 11s in calendar year 2020 than 2018 and 2019 combined. And we still have a couple of challenging months ahead of us here. Navin, I'd love to start off with your perspective. I know from my experience working with a couple of clients in the March-April timeframe, it was challenging at that time to get landlords to offer concessions. And as we see in many retail and restaurant cases, oftentimes the ability to reject a lease is one of the drivers of utilizing the tools of Chapter 11. What's been your perspective as things have played out over the last several months in terms of landlords' willingness to cut a deal outside of court, and how do you think that will impact the volume of Chapter 11 filings in the coming months?
Sure. So I'll give you just a general perspective. Just now having been in this COVID environment for a few months, there's certainly some themes that you can sort of draw as it relates to just pain points associated with the restaurant industry that are unique due to COVID. And I'll just, if I may, just carve out a few minutes and just go through these, and then certainly I'll touch on the real estate, which is obviously a critical piece of it. But when I think about just the broader restaurant industry, and I think about just the restructuring community, some are directly involved in the restaurant space because they were experts in it prior to COVID, and then just happened to have more opportunities because of what's going on. And just given the sheer volume, to your point, of number of restructurings that are restaurant related, there's going to be spillover, and other professionals are going to obviously get involved directly or indirectly. So here's what I would sort of say are the critical issues. First and foremost, coming into COVID, and now just looking at the current state of play in the restaurant world, there's an onslaught of old operational expenses that are now coming to a head. So one good example of that is just at the start of COVID, a lot of companies were able to get rent deferred versus abated or eliminated altogether in the form of maybe like a change to like percentage rent. A lot of that rent, which was punted, is now coming to a head. That also includes things like vendor payments. There's a lot of lawsuits that have happened or will happen that will need to be defended, all at a time where restaurant operators are going to be operating under lower average unit volume. So that's one critical point. Another critical point is that there's just macro trends here. I mean, certainly everyone can argue that we are in a recessionary environment, or at least more so than we were pre-COVID. So when you take into consideration things like sky high unemployment, the roll-off of stimulus, the uncertainty of future stimulus, all of that creates a perfect storm. In addition to just the general macroeconomic trends, we just have weather. Certainly it's fair to say that winter is coming, and that has huge implications for the restaurant industry, particularly for those that still have dine-in restrictions. Continuing on, there's obviously an onslaught of new operational expenses. So think about all the compliance, the training, cleaning materials, the plexiglass, all the things that were set up or will be set up. Think of outdoor heaters, having to set up things like third-party delivery services, eliminating some of the margin associated with having to pay third-party groups for that, just getting digital ready. That is a huge burden for a lot of restaurant operators that they can't avoid. A few more here. We certainly have a worried lender community. Prior to COVID, the restaurant industry was hot. There was a lot of private equity. There was M&A. We had low interest rates, and we saw incredible M&A activity. And now what you're seeing is in many cases, the lender community is inwardly focused, particularly a lot of these new lenders, the private credit groups, BDCs, et cetera, that have evolved into this space. A lot of them have either gone away or will be going away, but at a certain minimum, many of them are inwardly focused. A couple more. With that, the private equity community that has been the fuel to a lot of the activity in the restaurant industry, a lot of them are dealing with their own challenges as they confront valuation challenges, understanding whether they are in the equity or not in the equity. Obviously valuations are very nebulous at this point. The private equity community that I know that historically has been active is either on the super high end, like we're seeing Rourke potentially making a run at buying Dunkin' brands through the portfolio company Inspire Brands, or they've now become more special situations in the distress side and looking at very opportunistic investments that fall in sort of the bankruptcy distressed arena. And then the last one I would just mention is that a lot of local economies are in shambles. So besides the backdrop of the broader dark cloud of COVID, when you look at certain markets like Las Vegas or Orlando, as an example, where those markets were dependent on groups of people going into those economies and doing things, whether family, whether professional, all of that's been shot. And so the whole concept of, going to, a market that was typically high growth, that was a good function and barometer of the economy, a lot of that's gotten inverted. And so there's certainly a lot of challenges going on. And to your sort of earlier question, Steve, about just, what's happening in court versus out of court, there's really no roadmap. Everything that we've been doing has been unprecedented from a restructuring perspective. But in the sort of arena of a bankruptcy, there's rules, there's process, there's procedures, there's at least a flow that allows for a roadmap to try to do things, whether it's a plan, as we're seeing in some of these larger restaurant deals that are going from a debt to equity conversion or to a sale, where you're bringing in new investors and they're able to cherry pick leases and try to buy assets on the cheap via a 363 garage sale. So there's certainly a lot there, but certainly it's been exciting to say the least.
So by the way, I love the Game of Thrones reference to winter is coming, and I do want to come back to that point in a follow-up question for Vin in a second. But before I let you off the hook, I just want to poke and prod a little bit harder one more time here. What's your sense? Or is it let's make a deal time with landlords, or are they just making a generalization here? Still digging in their heels and trying to get their tenants to abide by their contract. How would you generalize the state of play?
Yeah, so the state of play is certainly let's make a deal from the perspective that it's certainly not a favorable environment to be a landlord, just given the supply-demand imbalance. In bankruptcy, a landlord does not want to have to deal with a lease that gets rejected. If you, let's say, are a landlord behind a casual dining box, not only are you going to have the uncertainty of who's going to fill that space, you're going to have downtime, you're going to have your own carry costs, you're going to have to incentivize someone to come to the table in the form of some sort of capital or tenant improvement allowance, you're going to have to pay broker fees. And so it's a very difficult time to be a landlord in this market, particularly in a bankruptcy setting where at least you get rejected. And in many cases, you have a claim, a 502b6 claim or unsecured claim that's worth zero, just given the waterfall of how the payout would go. So it's certainly not only a favorable environment for restaurant operators, but also an environment where restaurant operators can get flexibility with the term on the lease. So, by way of example, in a bankruptcy, you can assume or reject the lease, but then once you come out of that, you sort of lose that window. One of the things that we're doing in the context of our restructuring work is we're getting either early termination rights added to a lease. So that way, coming out of bankruptcy, if the trends continue to deteriorate, the company or the debtor has the opportunity to then reject that lease or cancel that lease after the bankruptcy, or in some cases, just shortening the term. Out of court, it's very confusing because there's a lot of noise in the marketplace. And so everyone is going to their landlords and asking for handouts. And so it's more context driven, Stephen. In many of our cases where we're working out of court with companies, it's more of here's how deteriorated the company's financials look. Look at the P&L, look at the balance sheet, look at the leverage. And there's a fact pattern there to support either trying to get out of bad leases in terms of buying them out, or getting significant concessions to the leases, moving to percentage rent, lowering the rent considerably. So there's certainly a lot of leverage, and it certainly let's make a deal time. With the notable exception that in the restaurant industry, fast food has been resilient, and in some ways, fast food and the valuations and just the demand for that real estate has actually gone up as a result of COVID.
Well, that's great. Thank you for that. And you triggered a couple of thoughts. But before I move on from that, so in the theme of let's make a deal and winter is coming, then if I could turn to you, I'll share a perspective more generally in the market. Based on my colleagues and my firm's level of activity, M&A appears to be booming right now. The capital markets are seemingly open. And from my vantage point, if I had to generalize the market, I think, the general sentiment is let's get a deal done, before the election, before calendar year end, before the uncertainty of an uptick in COVID. And I'm certainly seeing that across all industries. Now, I want to double click on restaurants in particular. And my question to you is, does that hold true in the restaurant industry, particularly given that winter is coming and a lot of restaurants have pivoted and made available outdoor dining, and there's talks of upticks in COVID and lockdown. What are you seeing from your vantage point in terms of the access to capital and just the overall state of the M&A market as it relates to restaurants?
Sure. I think you got a bunch of questions in there, but let's, high level, let's discuss what's driving the entire restaurant transaction spectrum, if you will. It's liquidity. And what do I mean by that? So let's say you have, I think exactly as Navin said, what I call the fast food side, the QSRs, which is basically the quick service restaurants, they're doing very well. Crystal's also an example which came out of bankruptcy, is doing very well. We were the lender advisor on that. But the remaining restaurant groups, fine dining, it's a little bit all over the place, but the key is liquidity. So let's say that from the current stakeholder standpoint, if the company needs liquidity in the next quarter or two, the question is, who's going to put that money in? Is it going to be the equity? Is it going to be the debt holder? Or do they just sell the asset? So if there's uncertainty around how much burn the company is going to have in the next 6 months to a year, what we are finding is that more often than not, lenders are saying, we're not going to put new money in. Let's figure a solution, which means it'll drive it to a sale. Many folks there are trying to do an out-of-court sale, primarily because there's just a huge cost of going into bankruptcy. Now, I think this is where Navin comes in a little bit, because real estate becomes a key focus here, and the question comes up, can you do enough with the landlords outside bankruptcy and then not need to file? Is there other litigation, et cetera? We just did a deal post-COVID where it was done out of bankruptcy. There was some lease issues, but the hope was that they would get resolved. May not be the best outcome out of court, but the saving in bankruptcy costs will be very high. We're doing one right now where, again, it'll probably be an out-of-court transaction. There's strategic buyers who are looking at assets and saying there is value here. Things will come back as long as they're convinced about the competitive position of the brand, and they're willing to put money in. One of the cases we're doing right now is a deferred consideration. So the strategic would come in, they would put some money in, and then hopefully things come back or the burn reduces, if you will, and then they'll pay their future payments for the consideration in the next year or year and a half. So that's the overall environment. From a financing standpoint, it's an issue. the new financing source, whoever it is, traditional or non-traditional source, is asking the same questions which we are talking about. What's the burn rate? What are the projections? And as a result, they're coming up with leverage, which is candidly pretty low because no one really knows what the true projections are. So we're seeing, again, when financing's involved, people are being creative. Equity has to spend more money to try and do deals. I think from an investor standpoint, interestingly, we're working probably with 3 or 4 people who are saying restaurants is today a special situation opportunity, but history has shown that if you get in times like this, the returns in the future are clearly above par. So we've got people, we're trying to explain the restaurant space to them. They're selectively looking at assets. They may or may not need financing, depends on the transaction size of the deal, but people are getting in. Personally, as I look at the stakeholders, I see the restaurants positioning. I'm actually probably not as negative as many others in the industry. I believe that there's going to be not an insignificant amount of capacity which will get taken out, and then people still want to go out. And once the vaccine comes out, and again, there's less of an impact where people are staying at home, whether that's 6 months later or a year later, I think the demand does increase and valuations will increase. So in general, I think that this is the right time for people to selectively start looking at the restaurant space and considering transactions.
Yeah, I would just add, and Steve, I know you're moderating, I'd love to get your thoughts on this too. I mean, outside of liquidity, the biggest issue that we see in terms of challenges is just what is the value of a business in the restaurant space today, where there's revenue is completely shot, the cost structure is completely altered. There's a lot of uncertainty as to what's going on in the future. So curious to hear your thoughts on just valuation and how you advise, whether it's a lender or whether it's the company, how you go about actually valuing, the current restaurant sort of business.
Well, that's a great question. So let me approach it, I guess, from a couple of different perspectives here. The old tried and true saying of cash is king, I think always holds true. And at the end of the day, what we look for when we're trying to triangulate a value for any business is what is the cash flow generating ability of this business. And where there is a high degree of uncertainty, then you have high discount rates, and discounts apply to that valuation. So I think the methodology and the approach is the same. It's that level of uncertainty, and I would say from my vantage point, what I'm seeing is a big disparity between, as Vin pointed out, the quick service restaurants and fast food, and those restaurants that have drive-throughs, or the customers have been trained over the years for more of a grab and go type of dining experience. They're doing very well, and the valuations are actually holding up. And I think a big underlying reason for that is that the operating costs of those businesses is a lot lower than casual dining, as an example, where you need to have more staff and you need you've got bigger footprints of your restaurants. Like, from what I'm seeing on my vantage point is a lot of interest in the market and high valuations on the quick serve fast food side, and I'm seeing more distress and more asset-based type valuations on the casual service side of things. I'd be curious from your vantage point, and Ben, yours as well, how you're thinking about it.
Yeah, let me jump in. Thanks, Steve. I mean, it's interesting. Pre-COVID, one could say valuations were depressed, but people were still actively, in certain cases, paying up if they wanted the brand and they saw synergies. Post-COVID, what we've seen is, leaving the QSR segment aside, what we've seen is valuations are probably down 25 to 50%. We are seeing strategic buyers pay more because A, they want the asset, and B, there's a huge amount of synergies. So they are more active. We are seeing sponsors trying to gravitate to some sort of a multiple on a normalized four-wall EBITDA or restaurant level profit or even EBITDA. But there is a struggle there because I think, as you made the point earlier, what is the normalized EBITDA going forward? In general, the way, we just launched a sale process last week. This is for a fine dining Italian restaurant group. It's got huge growth potential. There's some other unique characteristics about it. However, 2020 and 2021 candidly are what I call transition years. And whilst there is some liquidity need, it's not that great that a business can sustain those 2 years. So, our pitch to the buyers is that you cannot apply a traditional multiple to it. You've got to almost go out 3 years, and you've got the staying power, and you've got a future growth option. So would you rather do this or not do a deal at all? So I think, again, it's in some ways our sector's been disrupted a fair bit, and everyone's looking at new ways to try and create value. But in general, if you were to value something today, I would say it's between 25 and 50% off the pre-COVID valuations.
Let's make a deal. And part of the reason I was asking about the valuation or mentioning that is it sort of informs who's actually going to put up the money. Because in many cases, these restaurant chains will end up in a bankruptcy because that's the cleanest way, not only to cherry pick leases, but to deal with issues like PPP money, which, it's a little bit more nebulous when you're trying to buy a chain out of a process, when you have sort of the uncertainty of how things like government money is going to be treated, versus when you're buying it in a bankruptcy, it's, an asset sale. I've seen different instances where the lenders will put up the DIP money. I've seen certain groups offering to provide a DIP loan as a sort of a, DIP / stalking horse bid. I'm seeing that in 2 live deals right now. I've seen some cases where the sponsor thinks they're still in the money. They'll put up some of the DIP just to have optionality because there's a perception that they can still stay in the deal somehow. Are you guys, like, how are you seeing sort of the evolution of these distressed deals and the liquidity going to sort of, we're going to file, and who's actually putting up the DIP money?
So do you want me to take a first crack at that, Stephen?
Yeah, sure, please, and I'm happy to chime in.
Sure. So, in terms of the DIP, it's mostly the incumbent who's doing it, or someone who's going to buy the asset, who's willing to do a DIP and then ultimately roll into their final consideration. What we're generally finding is that a lot of folks don't want to spend the time to be the stalking horse or look at that DIP, if you will, because they may or may not win the deal, and it's a lot of professional fees to pay while they're doing all that work. The lenders are struggling to candidly put additional money in. Some institutions have clamped down and said, unfortunately, there's no new dollars, which is going to go out to certain subsectors in the restaurant groups. So I think with them having issues, sponsors are raising their hand in some cases and saying, all right, we will put some additional money in, extend the runway. Let's look at out-of-court options. And if you're going to do a DIP, then we need a transaction in advance for the DIP. But at the end of the day, Navin, you raised a very good point. That's going to be very crucial as you explore transactions in bankruptcy. Because if you have a second wave and you have someone committing to, say, a $20 million DIP, what happens during the second wave? The DIP needs become from 20 to become 40. What happens then? And these are the uncertainties which, in a way, do depress valuations and give the buyers some pause.
So then, thanks for that. Let me add a couple of perspectives, if I may. And Navin, this will tie into why I was pushing you so hard a little bit earlier in terms of what you were seeing. I'm in 2 situations right now with clients out of court, so I can't disclose their name, but the situation and the theme, I think, is relevant to this point of the discussion, and that at the onset of the pandemic, they were both struggling to cut deals with their landlords. And fortunately, they both had enough liquidity and availed themselves of PPP loans, and were able to get themselves through the summer. And as we find ourselves now in the fall in both of those instances, they've been able to paper enough favorable deals with their landlords that as a result of that improved liquidity outlook, they're able to go out to the capital markets and attract new capital. So it's been interesting from that perspective, where it's the ability to improve your operations and cut deals with the landlords has a direct correlation to your ability to access capital through the capital markets. In another situation that I'm in right now, the only capital available is from the incumbent lenders, who ultimately had to modify their covenants and go a little bit deeper on their loan. So from my vantage point, there's a mixture out there, but in my experience, it's been directly correlated to the success of the restaurant in modifying its leases on much more favorable terms, given their outlook. Okay, well, this has been an interesting discussion. I'd love to try to bring this all together and tap into your respective crystal balls and get your view on where we're headed, right? We've talked a lot about what we've seen and how unprecedented it has been. The fact that we've seen more Chapter 11s in the restaurant space in 2020 compared to 2018 and 19 combined, and we still have a few months left in the calendar year. My first question to the two of you is, this was a baseball game. What inning are we in here? Is this the third, the sixth? Are we in the bottom of the ninth and about to turn a corner? You guys have a perspective on where we're going to be over the next 3 to 6 months?
Yeah, I'll start, and I'll say this with knowing that we're in the middle of the World Series and it's been exciting. And but, just looking out the window here, I live in Chicago. It's the first day of snow. Going back to just an early analogy, like winter certainly is coming. There was a whole host of bankruptcies that occurred right at the start of COVID just because of liquidity issues. A lot of restaurant operators got government money in the form of the CARES Act, PPP money. That has eroded, and a lot of the underlying implications and just the broader sort of profitability just isn't there. And so I think we are going to see a long series of bankruptcies. Unfortunately, I think some of them are actually going to be Chapter 7 bankruptcies, like we saw with Garden Fresh, where there's just no money to propagate these businesses. So I think there is going to be a wave of restructurings. It's interesting because every action has a reaction. So when you think about some of the things that people are doing to adapt and survive here, like using third-party delivery services as an example, there's been a big proliferation of whether they're doing it internally or using groups like Grubhub or Uber Eats. That comes at an expense. Those companies charge, take away from the margin from the operator. And so, when you're skating on thin ice and someone comes to the table and makes it thinner, it's not necessarily a good thing. So I think everyone's trying to, pray and hope that we, get through the nonsense of this election, that we see some sort of pandemic relief in the form of government fiscal stimulus, and then certainly from a medical perspective that there's a vaccine. But like in the absence of all those things happening the right way, there is a lot of pain, and there will continue to be a lot of pain. And I think the trend of the restaurant industry being sort of the leading category of restructurings will continue, just because there's a sheer large volume of restaurant companies in the country, and the pain there is very acute. And so I wish I could be a little bit more optimistic. I think the restructuring community is going to be very busy for some time to come, as well as working with restaurants.
Now, Vin, earlier on, you had taken a more optimistic view of the market. Can you please share your thoughts, and if you have a contrarian view, perhaps?
Sure. The way if I had to pick 3 things which a restaurant stakeholder management team should be thinking about, right? I would say number 1 is put your capital structure issues and liquidity issues behind you if possible. I think Navin's got a good point that Chapter 7 will be an unfortunate reality for some, but let's leave those aside for now and say everyone else should be able to solve their issues. Once you solve them, solve it quick so you can be proactive and not just be in a state where you're waiting for the next quarter to hit and you're very inward focused, if you will. So that's point number one. We're seeing some companies do it. I had a conversation last week with the CEO. He's got a roadmap to $1 billion of revenue. He wants to make acquisitions, wants to understand what's happening because his capital structure issues are behind him. In terms of overall the restaurant pie, and this goes directly to your question, Stephen, I believe that the Uber Eats and the Grubhubs of the world are going to increase the overall restaurant pie. And capacity is going to come down, say, by 20-25%. So if you are a remaining restaurant today, you've become more efficient, and post-COVID vaccine, the market share is even the market size is flat to increasing. I think you just do a lot better. So there is the liquidity concern in the next near term, if you will, but I think many people will probably not have issues and survive that. I think people want to go out. If they can't go out, they want to order in. And I think that's going to continue. There was another group we were tracking probably a quarter back. They were 20% off in comps. Now they're off 5% in comps. So as I see these companies, what's happening the last quarter or two, things are changing. I mean, I'll give you another story and I'll end. But there was a management team I was speaking with. Before they put plexiglass in, they were 30% off in comps. And after they put plexiglass in, they could get the tables closer and the comps are down only 15%. So you're coming up with these new tactics, if you will. And I just think that there is demand. And overall, we may have an interim period. There'll be companies who will be filing for bankruptcies and they'll be doing out-of-court deals. But in general, I think we come back and we come back stronger.
Great. Well, before we open it up for live Q&A, maybe one last question, if I can tempt one of you to perhaps make a bold prediction. 10 years ago when we were at conferences like this, there was a lot of talk about e-commerce's impact on retail and the future of malls and shopping. Can I perhaps tempt either one or perhaps both of you to make a prediction in 3 to 5 years from now, what the future of dining looks like, and perhaps who are some of the winners and losers, and what do you think in 2030 the restaurant landscape is going to look like?
I'll start. I mean, I started my career off as a junior economist. I worked for the Federal Reserve Bank, and what I learned quickly is that it's mostly conjecture. No one really has a clue, what the hell's going to happen, and prognosticating is just a guess at best, right? But with that being said, the thing that people have to understand is that people are creatures of habit. And so when you get accustomed to doing something for a sustained period of time and it works, it's hard to change those behaviors. And so the real answer to your question is, people have to eat. That's not going to go away. Like, we're biologically set up where we have to put food in our mouth, right? 3 times a day. There's single people that have to go out and, try to get lucky and date and, entertain. And so, like, a lot of those things are never going to go away. It's just, what are the behaviors of consumers that are going to be there? And so I think COVID certainly disrupted a lot of behaviors. And then I think there's going to be a little bit of Darwinism as to who figures out how to survive from what's going on here. And then whatever those behaviors will be in a few years will dictate who wins and who loses. But, the restaurant business has always been about individual units making money on a 4-wall basis. So someone's got to continue focusing on unit economics. And if they can figure out how to drive people into a box or get food out of the box in the case of delivery and make money, they'll survive.
And I think the only thing I would add there, Stephen, is that I think the e-commerce comment I made earlier, I think that's going to be true. People will do more delivery. I think they'll use more services. But one point we didn't touch is I think menus will change. I think we're already seeing it in many restaurant groups. Food items which take a long time to prepare, they're just going to take it off the menu. They're going to streamline the menus. We're seeing it in almost 50-60% restaurant groups today. And whatever they have in the menu will be more profitable for them from a labor standpoint. They're quicker to make, etc. So I think that, so you'll see a lot on the operational side, but I'm bullish. I think in 10 years from today, I think the people who have to survive will survive in a market which the size is at least flat to increasing. And they would have learned how to make more profit than they were making pre-COVID. So I think it's just that interim period, but I think we come back strong.
Well, gentlemen, those are some really interesting insights, and I want to thank you for fascinating discussion. And I think it's probably now time that we open up to some live questions. Please use the functionality in the feature here to submit questions as we go. Let's start with the first one here. Any comments on exits made or new investments which are experiencing COVID tailwind benefits? Vin, you want to take that one?
Sure. Sorry, I think there was a little bit of interruption there. Can you guys hear me?
Yep.
All right, cool. That was a very good question. It's interesting. I think it's looking at the positive performance, which I couldn't agree with more. Companies that are doing better are mainly QSRs, and they're doing so much better. It's incredible. Probably you're looking at profitability in excess of 50 to 100% more in some cases. So those companies today, they've been absolutely no exits. There's a high cash and cash generation. There's also a lack of financing in the restaurant world in general. The lenders are a little apprehensive. So I think that will prohibit a higher multiple. So no exits there. I would say in the non-QSR groups that are struggling, if liquidity becomes an issue, that forces the transaction. So we've seen a fair number of in-code deals, out-of-code deals in those groups, especially if the lender is not willing to put more money in.
Got it. Navin, anything you'd like to add?
No, I just would say that we're sort of in a funky environment. Traditional M&A, so outside of distress, you see a lot of restaurant chains that have filed bankruptcy where the lenders ended up sort of becoming the equity or will be the equity. We saw that in 2J's. You're seeing that in California Pizza Kitchen and Chuck E. Cheese. There's in Ruby Tuesday to a certain extent. So there's certainly a lot of that. But then outside of a bankruptcy process, you're seeing a lot of unique deals. Work Capital made a preferred equity investment in Cheesecake Factory, which is very similar to what Warren Buffett did with Goldman Sachs during the Great Recession. We're seeing Callaway Golf make a strategic investment in Top Golf, where for them there's a strategic reason outside of just sort of paying a multiple of EBITDA. They can penetrate and get to a new demographic, and so I think you're just going to see all sorts of funky new types of setups and different animals. Certainly there are ghost kitchens out there in groups that want to take advantage of this online digital ready type business. You're also seeing a lot of SPACs that have formed as well. So I think this will be sort of a period of uncertainty, but also a period of just new kind of entrance into the market.
Great, thank you. Okay, let's take another question here. Maybe we'll start off with you here for this one. What are some of the unique ways you're going about identifying distressed restaurant chains out there?
Yeah, so I had a chance to look through the attendee list for this virtual presentation, and there's a mix of restructuring constituents, consultants, attorneys, bankers, turnaround professionals, and then some private equity groups. And so I think everyone here, outside of those that have just their own existing companies on the private equity side, everyone's looking at opportunity and where they could potentially be creative. I have a bunch of different things, but I'll go over just 5 quick ones. Certainly everyone knows about DebtWire and Credit Intel. But then, the restaurant industry is heavily consolidated in the sense that there are a few very large food vendors. Notably, there's Cisco, US Foods, and Gordon Food Service. Having relationships with these companies or through their, legal groups that represent them, understanding where they're having issues associated with restaurant groups not making payments or having some hiccups. The SBA, through the CARES Act, issued PPP money to thousands of restaurant participants, from small mom and pop operators to publicly traded companies. There's a database available of companies that were recipients of the PPP money, so you can actually search for that. So there's a lot of data mining there that you can certainly dig into and get a sense of, who received large government related funding, and there's a correlation behind some of those that received a lot of money and those that might have some stress, given that money's pretty much running out. Three other ones that I think are kind of interesting. A lot of the publicly traded REITs, they obviously have to file quarterly financial statements with the SEC. So I've been, besides listening to earnings calls, I've been digging into the 10Ks and the Qs, try to getting a sense of where they're having portfolio issues. In some cases, they mention specific companies, restaurant chains that are having issues. That also goes true with a lot of the publicly traded BDCs. Notably some that have had restaurant holdings, they certainly have to provide for FAS-related reasons, ones where they're concerned about where they're in a non-accrual or impairment status. Just being in the non-glamorous side of restructuring with landlords and negotiating thousands of leases across the country, we have our own data, and we do keep track of a lot of the publicly traded restaurant companies and the privately held restaurant companies, and have a good sense of which companies are paying rent or not paying rent. And that data is very helpful, not only in informing our restructuring strategies, but also understanding which ones continue to have issues or will have issues. And then, because the restaurant industry, while we're talking at a national level, it is very much a local economy business. I am tracking all the states and trying to understand which ones have dine-in restrictions, and there's obviously acute pain, as particularly states that have cold weather markets like Chicago, like New York, have these dine-in restrictions. It does cause further pain. So those are just five that are sort of a little unconventional, but should hopefully give people an opportunity to procure opportunity in the restaurant space.
Vin, any tricks of the trade you'd like to share with the audience?
Yeah, no, I the way I think about it, right, and I was going through the questions too. I think Navin touched a little bit. I think people are asking good questions. People are asking about transactions. They're asking about what's happening in the restaurant world. But I think, to Navin's point earlier, the deals are all over the place, and people are really looking at funky structures. So, for example, out-of-court deals versus in-court deals. If you went back to the last cycle, most buyers would tell us, we don't want to buy anything out of court. We like to go in court, etc. And today, this year itself, I've seen 3 out-of-court deals, different types of deals. One was a recap between the sponsor and the lenders. The sponsor put some money in. One was a deal, this is public, Boston market, which again happened out of court. Numerous reasons, and you're probably losing a little bit of leverage, but at the same time you're saving cost. And we just wrapped up one yesterday, which happened out of court, and people are looking at it and saying they like the savings out of court. You do lose a little bit, but if there are no outstanding liabilities, they're coming up with different deal structures. So what I would encourage people, I think people, as people say, we want to do restaurants deals. We want to see if you're in a restaurant today or your management teams, there are different answers. So I would say explore the answers. An out-of-court deal can work, and people are more open-minded to it.
Great, thank you very much. I see one more question here in the queue. What are some of the ways you're seeing restaurants transform themselves as a result of COVID? So maybe I'll take a first stab at this one, since I put you guys both in the hot seat, and then turn it over to you. And I'll take the most obvious one, which is food delivery. In particular, food delivery powered by apps. There's been an absolute explosion of usage of third-party delivery services such as DoorDash and Uber Eats, which has made it really easy for customers to order from a wide variety of restaurants, not just quick serve and fast food. And while that clearly has been a trend for some time, it got a tremendous boost as a result of COVID and has enabled restaurants to maintain comp store sales pretty close to in some examples of where they were pre-COVID. I've also seen some of the bigger restaurant chains launching initiatives that would, for example, allow outside restaurant brands to use excess kitchen capacity and existing restaurants, but strictly for delivery, right? Not to compete for their customers in their dining room. We've also seen some restaurants experimenting with ghost kitchens that focus on delivery only. That, again, not a new trend, that certainly has been around for years now, but similar to my comment about the apps really fueling a change in buying and how customers are engaging with restaurants. We've seen a proliferation in particular over the last couple, 2-3 months in terms of how restaurants are tinkering with that as a concept. And finally, drive-throughs seem to be all the rage. Fast food has held up, quite well from a same-store sales perspective, largely due to drive-throughs. And I've also seen a lot of national retail chains rationalizing their footprint, and one of the criteria that they're utilizing is which locations either have a drive-through window or have the ability to be modified to add a drive-through window. Vin or Navin, I'll pass it over to you to see if you have any other comments to add to that.
I think you covered most of the ways that restaurant groups have tried to adapt. The one that I would say is most interesting, I was talking to the CEO of Benihana, which is a privately held group. And when you think about that business, it's groups going there for birthday parties, date night, there's a little bit of theater and entertainment. And I thought that their business would have gotten whacked considerably. But they've been incredibly resilient. And what they did was they created a very consumer-friendly online ordering experience. If you go to like Benihana.com, you'll see that it's super easy to order, meals for the family. And what they've done is you can combine alcohol into it as well, and that allows the average check to go up significantly, and it sort of solves and provides a solution for the family where they just provide everything, the food, the booze, and then you just go online and you either pick it up, curbside delivery, or have it delivered. So I think the coolest restaurant groups that have adapted here have not only figured out how to survive, but also thrive and do things like bundling and creating more of a value proposition in meals. Particularly being able to use alcohol to boost margins, I think is a very cool idea. And, it's something that's a little bit unique from what people have done in the past.
Yeah, I don't have much more. The only thing I would say is that frequent customers, the chains who didn't have it, are really focused on that now because they want to control that population pool. People want to go for quality. They want to go to the same box they've been going to earlier. And second is delivery. I think people are learning that they'll rather not, at least for certain locations, rather not give delivery away and again just do it themselves. So lots of new models. I talked about plexiglass earlier. I think I talked about menu rationalization. So this is for the first time that everyone's looking at every aspect of their business. So I do believe that after the COVID noise is over and there's a vaccine, I think restaurants are going to be in a significantly better place, at least for the ones who are remaining.
Great, thank you. Well, I don't see any additional questions here in the queue, so I guess you can wrap things up. I'd like to thank all of our attendees for joining us today, and we certainly look forward to seeing you at the next webinar hosted by the M&A Advisor.
Great. Thank you, Steve. Appreciate it.
Thank you.